But moving on, we have Srinivas Ravuri joining us on the show, the CIO Equities at PGIM India Mutual Fund. Srinivas, hi, good morning. Thank you so much for making time and speaking with us. The question that we're asking is that India has remained quite resilient so far versus the rest of the world. Do you think this outperformance is likely to continue, or at some point India will really catch up and bear the brunt of the sell-off that we are seeing?
Good morning, Aisha. Yes, India has been extremely resilient, but doesn't mean that we will not be impacted at all by whatever is happening all around. So to that extent, I am not in the camp that nothing will happen to India. Though many things are very good for the country in terms of overall macro stability, I think that's the number one thing that is in our favor. Along with that, corporate India is doing very well. But at the same time, I think things like trade deficits are definitely a concern. I don't think we should be thinking that everything is great in India, nothing can impact India. I don't think that's the positioning that we should take, or neither we are looking at it that way. But we are definitely much better place relatively, and then that is what is reflected in the resilience. But we can't take things for granted, especially looking at the way things are moving, including the way markets moved in US yesterday. So we need to be very watchful, careful. Earnings are on our side, but even the result that have come till now, if you see the results, I think top line holding up pretty well, but there are challenges on margins and profitability. So I'm positive on the market outlook, but I don't think we can be completely cut off from the global market. So to that extent, one need to be watchful.
You talked about earnings. Just wanted to take a follow-up there. Do you expect the slew of downgrades really to continue or post this quarter as well? Or do you think a large part of it is factored in the analyst estimates already?
I think a large part is already done, but I think what we also need to remember is I think results that are out till now are from the large companies. We've seen typically relatively weak numbers come in the second half of the earnings season. So we've just entered that. So to that extent, one has to wait in terms of what happens to the other companies that will report numbers in the coming few weeks. Broadly, I think the sentiment, the mood has changed from earning upgrades to marginal downgrades that we've started witnessing in the last few days. I think that captures the mood, and I don't think we will see a big downgrades going forward.
Right. Sir, you've looked at various cycles, and I just wanted to understand about this sell-off that one has seen as far as e-commerce companies are concerned, or the valuation derating that we have seen. Time and again, market teaches us that whenever you pay higher, or whenever there is a lot of buzz around anything, it tends to underperform until numbers do come in.
Absolutely, Pankaj. I think we have seen this. I have seen this in various cycles in 99, 2000, when the IT boom. People are willing to pay the same 100 PE plus, and you know what happened after that. I think something similar is happening right now, and I think we at PGIM have been fortunate to stay away from the expensive companies. We are not questioning the business models, but I think what is very important for investors is what are you paying for? And I think that is where the realization is now dawning on people, that finally what matters, company may be great, business model may be great. So that same has to be reflected not just in top line, but also in bottom line, in cash flows. And when that is a question mark, then everything changes. So unfortunately, or maybe fortunately, I think it's an opportunity for astute investors to cash on this. So we see these cycles where people get excited, are willing to pay on different valuation metrics rather than price to earning, are looking at ROE and ROCE. And then when market changes, things change, we will see the kind of correction that we are seeing in few stocks right now, Pankaj.
Right. So, correction also brings in a lot of opportunity. And a lot of these companies have, tried and tested model. They have done well. They fulfill a real value of a customer. How would you choose these companies in terms of valuation matrix? Because a lot of them are at an EBITDA level, maybe profit making marginally, or, at a profit, at a PAT level, they are loss making. So how should one value these companies?
So, I'm okay with EBITDA, Pankaj. PAT or EBITDA. I think there is no need to go top line for sure. Also I'm saying why EBITDA, because there are certain business models where you are investing heavily to make sure that you acquire more customers, you increase your moat. So there is no need to penalize a company when company is investing to acquire more customers. But EBITDA is a clear proof that company's business model is genuine and they are profit making. So EV by EBITDA and price to earnings, I think these two should be the most important parameters when you look at it. And when it comes to price to earning, let's say if the broader market is trading at 17, 18 PE, the broader market is trading at the last 10 years, 15 years, profit growth is, let's say, 15%, 10 to 15%. So if these companies are likely to report double that, then you can pay a higher price. But eventually that growth will slow down. So to that extent, broader market trading at 18 PE versus some companies trading at 40, 45 PE, I think that can be justified. But the moment you get into this 3-digit PE, I think there is a challenge. I think that's what one need to take into account.
Oh, well, yes, 3-digit PE is something that we all need to be watchful of, but a lot of them have seen 3-digit PEs and they continue to be, like case in point being Avenue Supermarts for that. But other than that, it's Nykaa which is coming under pressure from the business models that you just talked about. But one space which is seeing quite a bit of good result reaction has been the entire banking space, right? How are you looking at this entire space? And interestingly so, your frontline banks, the likes of HDFC Bank, Kotak Mahindra Bank, haven't done much. But it's the likes of Axis Bank, IndusInd Bank, and even the smaller banks, the likes of Bandhan, RBL, etc., that have seen quite a bit of traction, and Federal also in that list. How are you looking at the banking space? Is it now time to look at the smaller banks? Because I see in your top holdings, ICICI is your top bet.
Yeah, so first, I think we've been fairly positive on financial for the last 2 quarters after being underweight for many quarters on the banking space. I think right now many things are in their favor, as Mr. Uday Kotak rightly put it, Cinderella moment for the banking. Credit growth is picked up, cost is on a lower side, NPA cycle is clearly behind us. So I think many things are in favor. That's why banking looks very interesting. And the second point about large cap versus mid cap banks, actually I think this is what the beauty about market is. So you have to see what is priced in. So many of these large cap have actually delivered very well, but I think that is a known thing to most of the investors, and that's the reason we've not seen a big move. Whereas in the other banks, the moment you see a positive surprise on the result, the reaction has been very different. Having said that, I would continue to like large cap banks. I think that's where we have a stable earnings growth ahead. Mid caps or opportunistic play, I think we have invested in few names. So I think selectively, I would say even where the franchise is great, where the liability has been good, market share gains have been decent, we are open to look at them, and we invested in few. But first preference would be large cap, given that even today, even after the stocks have done well, the valuations are not expensive.
Okay, so that's the word coming in. As far as the banking space is concerned, the preference really continues with the large cap banks. We'll let you go on that note, Srinivas. Thank you so much for making time and speaking with us, and season's greetings from ED Now family to you.
Thank you.
In fact, on that note, we'll slip into a very short break. But